Dropbox looks like a very interesting tech stock. It is trading at a fairly low PE ratio, and it has even started buying back shares aggressively. But there's a reason for this. Dropbox business model is just simply terrible. So while it is trading at a low PE ratio, it is just waiting to be disrupted and is maybe already being disrupted. Basically, Dropbox is the #1 leader for file and sync share, which is basically just a fancy word for cloud. They are cloud where you put your files on and multiple people can work together on them. And that is basically how they make most of their money. People pay for a subscription, for a business plan, a family plan, or just an individual plan for a Dropbox account. They have a lot of users. They have 18 million paying users and 700 million are registered. They have some other things like Dropbox Sign, which is very niche. It is basically like DocuSign, but way less advanced. You just sign documents and that's it. They also have some other stuff, but most of their money comes from just the normal Dropbox product where they host files for you. Now they're trying to make the business sound all fancy with design for users, button-up adoption, open ecosystem, live side by side. It is just a computer that belongs to someone else where you upload your files on, and if you put it on share, you can, for example, send it to your family member. On your company, you can have one Dropbox folder with everything in it. Now what is the issue with this business model? Sounds well overall. If they make money from it, that's fine. Well, the issue is there's no moat to this business. You wanna host files that you can together work on. Maybe Dropbox comes to mind. But let's think about this. You're already using Google products, or maybe you're using Microsoft Teams. And both of these providers have started providing that as well. And now's the issue. Are you gonna go with Dropbox? Or are you already gonna go into the integrated system, which everyone kinda knows how to use? You're not gonna have to train everyone, and it is already included in your software. Most companies, even if a competitor product is better, are gonna go for the integrated system. People hate Outlook. Ask half of the people who work with Outlook, they hate it. It doesn't find your emails, it is bad, but so many companies still use it just because it's integrated into their system. This is the same with Dropbox. Microsoft and Google are constantly improving their cloud solutions, and if businesses switch over, then Dropbox has a problem. Maybe families, etc. would stay on Dropbox because they don't have an integrated system, but that is not gonna make up. The $2.4 billion of revenue comes mostly from business customers. While yes, their paying users are still growing, and their annual revenue per user is also still slightly growing, it is just very at risk of disruption. We can see it in the revenue growth. This is the revenue growth of Dropbox. What is very interesting about it, it has not spiked in the pandemic. When did you ever need stuff uploaded on a cloud to work together on more than during the pandemic? And it has not accelerated growth at Dropbox. In fact, it has went down and down and down and down and down. It's currently hovering at around 7%. This is not a fast-growing tech company anymore. And from the looks of it, it is not going to be. Where would the growth come from? And they also don't have really the cash to buy new businesses that could generate that revenue growth or even invest into making their own products. Why is that the case? Well, let's look at their free cash flow. They make $749 million in free cash flow. They spent $670 million of it on buybacks. They have spent even more before. All of their cash is currently going into buying back shares. They're probably going to keep share buybacks at around this level. I don't see them changing this too much. Well, yes, they're heavily reducing share count, but if a business continuously loses cash flow afterwards, those bought back shares are gonna be worthless. I would rather make them pay out a dividend right now. And also one thing that's eating into your value is share-based compensation is growing faster than revenue. It has just continued going up. Of those 670 million in buybacks in the last 12 months, 344 were already eaten up by share-based compensation. Currently, the company is making around 400 million of free cash flow after stock-based compensation. That is around a 25 multiple right now. While yes, it is not extraordinarily high when it comes to the tech sector, usually the tech sector is very fast growing. And Dropbox is not growing at all, and no growth is in sight. Now when it comes to valuing Dropbox, they currently have a free cash flow per share after stock-based compensation of around $1. Let's say we assume that revenue continues to grow at around 6% because it continues to slightly decelerate but not as fast as before. They continue to buy back some shares. They have been using some debt to buy back shares, so that will be a bit reduced. 8% for the next 5 years, 5% for the 5 years after that, 10% discount rate, 15 multiple. We come to an intrinsic value of $10 a share. They're currently trading at 28, that is a 63% downside. What if it goes better for Dropbox? Growth re-accelerates, share buybacks continue at a very high rate, and they get a higher multiple. Well, then they come to a value of $24 a share, still not at the current price. And what if it goes worse? Growth continues to decline. They only can buy back a few shares, 2% growth over the next 10 years, 10 multiple. $5 a share. The risk-reward ratio for Dropbox is just not in the favor of the investor. To make a decent return, everything would have to go perfect and beyond. Dropbox, in my opinion, is just not a great investment. You get not a lot of upside, you carry a huge amount of risk, you carry getting disrupted by other way bigger companies who are just out to get you. Do you own Dropbox? Where do you see the future of a company? Write it down below. Have a good day.